A lot of people are confused about the difference between fund of funds and master feeder funds. They're completely different, but we'll go over both. We'll start with fund of funds because that's easier. So people of any salary can invest in an index fund or 401k, but what if you have more money and you want to invest in things that are a little riskier but offer more reward? Then you can look at hedge funds. And instead of you picking out individual stocks to invest in, you pick somebody else to do that for you. But what if you don't know how to find a good hedge fund? What do you do then? Well, you can hire somebody to vet them for you, and you give him your money, and then he'll dole it out to different hedge funds. So normally you'd have this setup where you have some multi-investors and they give money to the fund manager and he invests it and gives you the money back, assuming he makes money. But you're not a math guy, you're not an accountant, you don't know if this guy's any good or not. So while these two are okay with investing directly with him, you have some doubts, and so you want somebody else to sort of vet this guy and see if he's okay, and you're willing to pay for that. So enter the fund of funds. So you give your money to this person, and they will perform due diligence on each of these funds, and then they'll decide how much of your money, if any, to give to any of these, and you'll be paying these guys a fee, and you'll be paying this one a fee, but hopefully what they did is valuable enough that you still have money coming back to make it worth your while. So the main difference between a fund of funds and a master feeder fund is this person works for you and he's vetting these funds to invest your money, but he has no relation to these people. There are thousands of funds giving him pitch decks, but he doesn't have a financial interest in any of them. He's just going to invest your money after he does his due diligence. And if he does a good job, great. But if not, a lot of the money for Bernie Madoff's fund came from these fund of funds who would do their due diligence on different hedge funds and looked at his and said, this is all perfectly fine. And they lost their customers' money. So it's possible that you're paying for something useful and possibly not, but you're paying two sets of fees. You're paying whatever the hedge fund fees are. Sometimes you get a discount, and then you're getting the fund of funds fees, and your return from all of this is after fees and after these fees, and then it comes to you. That's fund of funds. So what's a master feeder fund? Well, it can get very complicated like this, but we'll start simple. And whenever you see complication like this, it's usually because taxes are involved. And this is no exception. So the simple version, here's the master fund. It's just a pool of money. So who's going to manage that money? That's the investment manager, the hedge fund person, right? So instead of putting everyone's money here, he sets up two funds. One is called the onshore feeder fund, which is US based, and one is the offshore feeder fund, which is usually based in the Caymans or Bahamas for tax purposes. And instead of everyone putting their money directly into the master fund, they put their money into these feeder funds, and then those funds invest in the master fund. And you might think, well, that seems very complicated. Why do you do that? Taxes. So in the US fund, you're going to have US investors that pay taxes. So those are accredited investors, people who make a lot of money but live in the US, so they're going to pay US taxes. And so when this fund gets money from people and then invests it and then gives it back to these people, this fund is going to figure out the tax situation, if there's withholding and everything like that, and then give it back to these people. But you've got foreigners who are not going to pay US taxes, especially because this feeder fund is in the Bahamas. So if you have a German citizen investing in this Cayman Island fund, they're not going to pay US taxes. So why would they pay for US tax counsel? They want their stuff separate. So the onshore US fund is for US taxable investors. And then you have the offshore feeder fund, as I said, usually in the Bahamas, Caymans, sometimes it's in Ireland. And they're going to have the investors that are foreign, and also the US investors that don't pay tax are going to invest in the offshore feeder, not the taxable onshore fund. So who in the US doesn't pay taxes? Usually pension funds. So they're located in the US, but they don't have the tax issues that you do. Could be nonprofits also, but they're going to invest in this feeder fund, and everybody's money is traded together in one big pool. And then it gets doled out to the feeder funds. And the manager, of course, will take his cut. So that's the very basics. That's the very basics, and we'll get a little into the weeds. So I did mention if you have enough money, you can invest in these hedge funds. So what does enough money mean? Well, generally you have to be an accredited investor. And the criteria for that is that you have a net worth of over $1 million, not including your primary residence, or you made $200,000 a year for the prior 2 years as an individual, or you and your spouse made $300,000 for the prior 2 years. So most people will qualify with one of these two: $1 million net worth, not including your home, or 200,000 salary for the prior 2 years, or 300,000 household income for the prior 2 years. And most people don't fit into this, but there are some exceptions to that. If you work at a hedge fund and you are considered sophisticated enough to be an eligible employee or something like that, you don't necessarily have to have 200,000 in salary or $1 million net worth. That's the exception, not the rule. And sometimes it gets a little complicated because there's a little bit of overlap, let's say, between the two. So here you have feeder funds feeding into a master fund, but the master fund is apportioning this out to different advisors, 1, 2, 3, and 4, and they might be trading different things. Maybe this person trades foreign currency, this person trades stocks, this one trades commodities like oil. So these sub-advisors are all going to get paid based on how much they make, not on how much the fund makes, and then the fund will decide how much to give to each of these. But this is not a fund of funds, because these feeders are feeding into the master fund, but all these sub-advisors work for the master fund. So in a fund of fund, this person is going to find people that he doesn't know and vet them and invest your money. But in a master feeder fund like this, it's pretty common to have sub-advisors, especially if it's a very large fund and they do more than one strategy. And that was the simple basics of it, and it can get more complicated, and we'll go over the nuances here. So here are the investors, and they invest in the feeder funds. Again, you're going to have offshore and onshore feeder funds feeding into the master fund, but the investors feed into the feeder funds, and the feeder fund feeds into the master fund. And the master fund is set up as a limited partnership. And in a limited partnership, you can have as many limited partners as you want, and then you have one general partner who manages the limited partnership. So if I invest $1 million into this feeder fund, because I'm a limited partner, I'm only liable to lose that $1 million. I'm not liable for anything beyond that $1 million because I'm a limited partner. However, the general partner, if they invest in this fund, which they usually do, because they are a general partner, they are 100% liable for what goes on at the fund. So if they get sued, I can only lose the $1 million that I put in, but because they're their general partner, they can lose whatever other assets they have beyond what they put in the fund. So an LP can have limited partners, but it needs one general partner. So this is the corporate entity that's the general partner. And to make things more complicated, they usually set this up as an LLC because they have unlimited liability, so they don't lose the money beyond what's in the LLC. And then the LLC will be controlled by a management company that's owned by the fund managers, and the people who are employees do the day-to-day stuff. But the fund manager owns the management company, which is usually the one that's registered as a commodity pool operator, investment advisor, etc. And because this is limited liability, they invest some of this in the general partner, which is also limited liability. And then the general partner has unlimited liability here and here, but you're pretty safe because even if something goes wrong here and here, you have to pierce the veil a couple of times to get back to here. And to keep from piercing the corporate veil, you want to cross all your T's and dot all your I's and make sure you treat them as separate entities. So even though the same people are here, 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 and here, you want to run them as separate companies and have an investment management agreement in place and different corporate documents in place to run all these things separately. Then you're off to the races and you can trade. As you trade, you need different things in place. So your tax people, your attorneys, stuff like that, we'll call those service providers, and you'll contract with them. You probably don't want that in-house because it's very specialized and you're better off outsourcing it because it would not be a full-time job at the hedge fund manager. So you're better off hiring people. Then you've got the different agreements with the prime broker, custodians, broker dealers. So your custodian and prime broker is usually the same person, but Here they have it on the chart as two different things. So this fund would go through broker-dealers to trade on the exchanges, and because they're large enough, they're probably also doing things like swaps. And if they're trading through different broker-dealers and have to put up collateral with each one, it gets expensive. So normally what they do is they trade with different brokers, whoever has the best price on whatever they're looking for. And then they have something called a give-up agreement, where those trades then go to their custodian and prime broker. And instead of having margin and capital at each one, you just have everything here in one place. And with that, you can net your related positions and have lower net capital requirement because you're doing what's called portfolio margining. And people think of trading and clearing as the same thing, but they're technically two different things. So when you trade something on the CME or the New York Stock Exchange, the exchange will execute the trade, but then they have to get cleared through a clearinghouse, which has all the money. So the big brokers are clearing members of the clearinghouse. So when you buy stocks, the stock certificates are held at this place, Depository Trust Clearing Corp. And then when you trade on the Chicago Mercantile Exchange or any other derivative exchanges, there's different clearinghouses for that. So I hope that was helpful. If you have any questions, leave them in the comments. Here's my favorite part, the disclaimer. I'm a lawyer, but I'm not your lawyer. Anything you see on here is for educational and informational purposes only. If you have a specific question about your specific circumstances, seek your own legal counsel for those questions. Nothing here creates an attorney-client relationship between me and you. I am not your lawyer. Okay, got it? Have a great day, everyone.